The financial world, often perceived as a complex labyrinth of numbers and elite players, was flipped on its head in January 2021. At the center of this seismic shift was not a multinational corporation or a government policy change, but a video game retail store named GameStop. This wasn't just another business headline, it was a declaration of war on Wall Street's status quo, brought forth by an army of ordinary retail investors. Their weapon of choice? A strategy known as the short squeeze, which turned the trading world inside out and left billion-dollar hedge funds scrambling. The GameStop saga, a David versus Goliath narrative, unfolded on the digital battlegrounds of Reddit and Twitter, where memes became the banners of rebellion. It's a story of how the silent, often overlooked majority of small investors found their roar, challenging financial giants and eventually rewriting the rules of the game. This essay unfolds the layers of this epic clash, revealing the mechanisms, the heroes, the villains, and the lasting impacts of the GameStop revolution. The GameStop saga began not with dramatic changes in corporate strategy or breakthrough financial reports, but with a post on Reddit's Our Wall Street Bets.
It was here that Keith Gill, known as Roaring Kitty, shared his bullish thesis on GameStop, a company many saw as a dying relic in the digital age. His enthusiasm and detailed analysis sparked interest among other retail investors, who began to see a unique opportunity. This interest quickly turned into a movement as more investors piled on, driven by a mix of profit motive and a desire to challenge the hedge funds, betting heavily against GameStop's success. The stage was set for a historic showdown, with millions of dollars at stake and the eyes of the world watching. As the movement gained momentum, it wasn't just about financial gain anymore. It was about proving a point, that the common investor could have a voice and influence in the grand financial narrative.
A short squeeze occurs when a stock's price rises sharply, forcing short sellers who bet against the stock to buy shares at higher prices to prevent further losses.
GameStop became a textbook example when its stock, pushed by a surge in buying by retail investors, skyrocketed from about $20 to a peak of nearly $500 within weeks. Hedge funds like Melvin Capital, which had short positions in GameStop, found themselves in a precarious position as their potential losses mounted exponentially. The buying frenzy was fueled by more than just the anticipation of profits. It was also driven by a retaliatory sentiment against Wall Street's elite. This squeeze not only affected GameStop, but had a ripple effect across the market, causing stock prices in other companies to be manipulated as well, showcasing the power and potential chaos wrought by coordinated buying.
Social media platforms, particularly Reddit and Twitter, were instrumental in the GameStop saga.
Wall Street Bets, a subreddit characterized by its irreverent tone and aggressive trading strategies, became the command center for the retail investor uprising. Posts encouraging members to hold their shares and buy more went viral, characterized by memes and a unique blend of humor and defiance. This digital camaraderie turned into a powerful tool for mobilizing and coordinating actions across millions of investors without traditional organizational structures. The impact of this collective action was so significant that it caught the attention of celebrities and billionaires who joined the chorus on social media, further amplifying the message and the movement's visibility.
The GameStop event highlighted a pivotal shift in the stock market, the emergence of retail investors as a formidable force.
Traditionally viewed as the small fish in a sea dominated by big sharks like hedge funds and large institutional investors, these individual traders demonstrated an unprecedented level of coordination and impact.
Using platforms like Robinhood, these investors executed trades that would collectively put immense pressure on short sellers. Their strategy was simple yet effective: buy and hold.
By refusing to sell their shares, they created a supply crunch, which further drove the price up, squeezing the short sellers.
This collective action not only led to financial gains for many, but also instilled a sense of empowerment among retail investors, who realized that their combined strength could challenge and even outmaneuver the titans of Wall Street. As GameStop stock continued its meteoric rise, the response from Wall Street was a mix of disbelief, panic, and outrage.
Hedge funds like Melvin Capital were forced to secure emergency funding to cover their losses, highlighting the vulnerability of even the most seasoned financial giants.
The situation escalated to the point where trading platforms like Robinhood controversially restricted buying of GameStop shares, a move that drew immense criticism and sparked allegations of market manipulation.
This decision led to congressional hearings and widespread debates about the fairness and transparency of the stock market.
Meanwhile, other institutional investors scrambled to reassess their positions and strategies, wary of becoming the next target of a retail-driven short squeeze. This event undeniably shook the confidence of Wall Street and prompted a re-evaluation of how the market operates. The regulatory response to the GameStop saga was swift and significant.
The Securities and Exchange Commission, SEC, launched investigations into the trading activity, focusing on potential market manipulation and the roles of social media and trading platforms like Robinhood.
This scrutiny has led to calls for increased transparency and possibly new regulations aimed at leveling the playing field between institutional and retail investors.
Some proposed measures include greater disclosure of short-selling activities and restrictions on trading practices that can disproportionately disadvantage retail investors.
The debate also extends to the role of social media in financial markets, with discussions about how misinformation and coordinated trading are to be handled in the future. These discussions are likely to influence how regulations are shaped in the coming years, potentially altering the landscape of stock trading. The media played a dual role in the GameStop saga, acting both as a narrator and a participant in the unfolding drama. Initial reports were often dismissive of the retail investors' chances against the established hedge funds. However, as the stock price soared and the narrative of a populist uprising took hold, the tone shifted. Major networks and financial news outlets found themselves at the center of a narrative that questioned their own roles in the financial ecosystem. The coverage was frenetic, with live updates tracking every twist and turn of the stock price, interviews with market analysts, and features on the individual investors driving the surge. This intense media focus amplified the impact of the event, drawing in more participants and influencing public perception. It also sparked a broader debate about the media's responsibility in covering complex financial events and their potential to influence market behavior. The psychological elements of the GameStop short squeeze are as fascinating as the financial ones.
Many retail investors were driven by more than just the prospect of financial gain. There was a palpable sense of participating in a cause, of fighting back against a system perceived as rigged. The concept of FOMO, or fear of missing out, played a significant role, as tales of massive gains spread quickly through social media, drawing even more investors into the fray. This herd mentality, combined with a David versus Goliath narrative, created a powerful emotional cocktail that drove the buying frenzy. Moreover, the psychological impact on the short sellers, primarily institutional investors, was profound. The pressure of facing potentially unlimited losses led to panic selling and desperate moves to cover positions, which only fueled the fire further.
In the GameStop narrative, Keith Gill, also known as Roaring Kitty, emerged as a folk hero, the face of the retail investor taking on the Wall Street giants.
His down-to-earth approach and deep conviction in GameStop's value won him legions of followers and admirers.
On the flip side, hedge funds like Melvin Capital played the role of the villain in the public eye. Their aggressive short-selling strategy, which bet on the failure of companies, was perceived as predatory and emblematic of everything wrong with Wall Street.
The public perception of these characters was shaped significantly by social media and media coverage, turning complex financial maneuvers into a story of good versus evil, which resonated with a broad audience far beyond the financial markets. The long-term financial impacts of the GameStop short squeeze are still unfolding, but several key effects are evident. First, there's an increased scrutiny and skepticism around short selling, seen by many as a risky and potentially destructive strategy.
Secondly, the event has spurred interest in other undervalued or heavily shorted stocks, leading to similar, though less dramatic, buying frenzies known as meme stock movements. This has introduced a new dynamic into the market, where social media sentiment can significantly influence stock prices.
Furthermore, the squeeze has prompted many retail investors to become more active and engaged in the market, leading to a surge in trading app downloads and an increase in trading activity. This shift could democratize investing further, though it also raises concerns about market volatility and the risks to inexperienced investors. The GameStop event transcended financial markets, influencing popular culture and sparking a broader discourse on economic justice and power dynamics. It inspired memes, merchandise, and is even being developed into films and documentaries. In art and literature, the saga has been depicted as a modern-day rebellion, akin to historical uprisings against oppressive powers. It has also sparked discussions around the globe about the fairness of financial systems and the potential for technology to disrupt traditional power structures. Moreover, it has raised awareness among the general public about the workings of the stock market, hedge funds, and financial regulations, making these topics more accessible and comprehensible to a wider audience. The ethical considerations of the GameStop saga are complex and multifaceted. These ethical debates are likely to continue shaping discussions around market regulation, investor rights, and the ethical boundaries of trading strategies. On one hand, the collective action of retail investors was seen as a legitimate use of market mechanisms to counter aggressive short-selling tactics. On the other hand, the volatility and risks introduced by such actions raise questions about market manipulation and the responsibilities of investors to the broader financial system. Additionally, the role of platforms like Robinhood, which restricted trading during the peak of the frenzy, has been scrutinized for ethical implications regarding market fairness and the rights of individual investors. The GameStop episode represents a potential turning point in financial activism, where technology and social media enable large groups of individuals to exert significant influence over the markets.
This could lead to more democratic financial systems or, conversely, to greater volatility and risk. Future movements may refine the strategies seen during the GameStop saga, potentially leading to more sophisticated forms of collective action.
Additionally, the rise of cryptocurrencies and blockchain technology offers new avenues for decentralized financial activism, challenging traditional market structures even further. However, these developments also necessitate a re-evaluation of regulatory frameworks to ensure market stability and protect against potential abuses of these powerful new tools. The GameStop short squeeze is more than a financial anomaly. It's a landmark event in the evolution of the stock market. It has highlighted the growing power of retail investors, the impact of social media on financial markets, and the potential for significant shifts in market dynamics. This event has not only changed the way people view investing, but also sparked a global conversation about the nature of financial power and democratization. As we move forward, the legacy of GameStop will continue to influence market practices, regulatory policies, and the ideological battles over the future of finance. In the end, the GameStop saga is a reminder that in the digital age, power can shift in unexpected ways, and sometimes all it takes is a group of motivated individuals to challenge giants.